Hello out there in the virtual land. I'm just Bobby Kinzer. Glad to see you joining us again. This wonderful, wonderful show that we do, 8 p.m. every Thursday, Eastern Daylight Standard Time on the East Coast. It's so great to see everyone. My partner, Dodie, there he is. Voila. And I say his name and he'll appear.
What's
So we
happening, my
are the
brother?
FITT Show. Financial information for today and tomorrow. I'm Bobby Kinson,
And I'm Thomas Doty.
and we are the FITT Show, trying to provide information to help our people empower themselves so they can join the financial mainstream in the United States of America. As always, just want to let you know we are here to provide information. We're not selling anything. But we're giving information, hoping that you can use it. We are financial educators. We're not financial advisors, so we are not. We do not have any fiduciary responsibility, as they say. But we will provide information about all kinds of things, especially dealing with personal financial management. So we've been here. This is our 118th show. We've been on a roll, dope. As you can see, ladies and gentlemen, make sure because a lot of people get confused when we do these shows. So I want to make sure y'all know today is Thursday, the 14th of September. This is live. We're all the way live. So thank you all for joining us. Just want to remind you that, please click on the like button, and that gives us traction. And the heart button, you click on that as many times as you can, and also put comments in the comment box. That also actually it compounds the actual number of people that we reach when you use the comment box. And we like to make this interactive, and that's how we make it interactive, by you putting comments in the comment box. So if you have any personal feelings on anything we say in a comment, or an opinion, put it in the box. Or if you have a question, put it in the comment box. And that's it for the administrative things. I'm just glad everybody joining us. We've been getting some great feedback from our shows. And like I said, we would like for you not to hoard this information. We hope that you share this with your family and friends, because you can go out on Facebook where we are and go into our archives under the FITT Show, FITT Show, and get any show that is archived. And you can also do that on YouTube. So make sure you share Facebook and you subscribe, or have your friends subscribe to us on YouTube. So, though, with that, it was a beautiful day here in the DMV, man. I'm telling you, it was just absolutely a beautiful day. How was it up there, down there where you are?
Absolutely gorgeous. 82, sunny, just another beautiful day in Charlotte. Beautiful weather.
Hey, though, something happened to the screen.
What do you mean?
Do you see me?
I see you. Mm-hmm.
Okay, something happened. It blew up and it took me off the screen. I thought you couldn't see me. It blew everything up, because you just never know about modern technologies. Okay, so let's get it started like we always do. Let's go from the top of the show, which everybody loves when we start off with this stock market. Though, now come on, one of these days you got to give us some good news on the stock market.
Well,
What we doing
funny.
today?
It's funny that the news is good. This has been a good week. If you look.
Oh, finally.
Yeah, if you look, the week has been good. The Dow is up 1%, up over 400 points. NASDAQ's up almost a couple hundred points, over 1%. Microsoft's up almost 3%. Tesla's up 10%. Apple's down slightly. And there's a lot of things going on with Apple right now with the new iPhone 15, which I think most people were underwhelmed by the new technology. So that always makes you wonder if as many people are going to upgrade, because there wasn't really any big technological leaps in the new iPhone. And The biggest difference is there'll be a new power cord. So Pfizer didn't change much. NVIDIA's down slightly. It almost had a 4-day losing streak, which had not happened since like 2020. And so, I mean, and that's to be expected. The stock is up over 300% this year. Started the year at about 147, and so now it's at 462. So it still has done real well. So it's just kind of taking a little pause right now. But the overall market, we're in that little time frame now where the Fed is meeting next week, and everyone is wondering if they're going to raise interest rates by a quarter of a percentage point. And so there was good news like today with the U.S. retail sales rose, and it's those things where you want good news, but you don't want it to be too good, where the Fed feels the need to slow down. It's like wholesale prices jumped 0.7%, and they were expecting it to be about 0.4. So that kind of creates a little worry that the Feds may raise the interest rates, and with the retail sales going up, that also. But most people still feel that the Fed's not going to raise interest rates next week, but they're going to put it out there that they are finished if things continue to go too strong. So that's where we are right now. I think next week is going to be a pivotal week once we see what the Fed does. Most people are expecting no increase, and so there may be a negative pushback, especially on the tech stocks, if the Fed does raise interest rates. So we'll just hold on to our hats and continue to hang in there, and we'll see what happens.
And for those of you who are into the commodities like gold and silver, just want to give you an update with that. Actually, gold has just been holding. It went over $2,000 an ounce a few weeks ago. No, actually a few months ago, but it's been holding around about at $1,900. It goes up, fluctuating. Just won't go over that 2,000 mark. And silver has been holding at about $22 an ounce. So the commodities, normally the market, commodities is an inflationary hedge. Usually when inflation go up, gold, silver go up, but it's just kind of flat lately. So I just wanted to give that. And then note the other thing, man, I think tonight, the United Auto Workers are going to make a decision if over 100,000 of them are going to go on strike from
about that. It's kind of funny because we're talking, Bob and I were talking yesterday, and Tesla already has a big advantage because they have non-union plants,
right,
which typically have lower costs, lower benefits, and they don't have that big pension carry forward that the U.S. automakers have. And so they're already at an advantage, and the big three automakers are just bleeding money in the electric vehicle market because they're just scaling up. They're just getting, just starting to produce those things. And it takes a while to get your scale going before you start making money. Where Tesla's already making money, they're rolling. So if a strike comes along, that's going to put the big three automakers in an even tougher position because they're already behind, and they are just putting billions of dollars into the EV market, and they're losing money. So it's kind of a tricky situation because if they avoid the strike, that means they'll be agreeing to probably a 30% wage increase over the next 3 years, which won't help their fight with Tesla as far as the cost of production. So this is going to be very interesting to see how it all shakes out. I think Tesla's going to come out.
Yeah, but things like that will affect the market.
Yeah, either way it goes, I think Tesla's going to be a winner in this. If they agree to a big price increase, that's going to make them more advantageous. And if they don't and strike, that's also going to help Tesla. So
right.
Yeah, the U.S. automakers got to start making some headway in the EV market and start making some money, or it's going to continue to get worse.
Yeah, and they're talking about a 40% increase in salary over 4 years, I think.
Yeah, it's a big number, and the reason it's they're looking at inflation and the fact that when times were bad, they kind of forego some big wage increases, so they feel they are owed some back pay,
Right.
just like the who's that UPS or FedEx? They
Yep.
were trying to get money for the money that they didn't get in the past, and plus inflation is beating up everybody. So they're saying these little increases, that's not improving my lot at all because everything is going up. So it's going to be wild to see how this shakes out.
Yeah. So, stay tuned.
That's for sure.
So let's get to my other favorite subject, and that's the cryptocurrency market. Now, as a whole, the crypto market cap has only went up by $2 billion. And last week it went up by about 5 billion. So it's not moving that much. But the Bitcoin actually have increased $347 per Bitcoin. It moved from $26,256 to $26,629, about a 1% increase. Everything else has stayed pretty flat, except Ethereum, which is what they call a smart contract, which is supposed to be a little bit better structured. It's down $17 a share. And Tether went up by a penny. That's the one that they call stable coins, which is actually pegged to the US dollar. Dogecoin went back down. It was at number 8. Now it's back down to 9. And Shiba is still pulling up the rear at number 16, though. So all you people who got in early, you definitely are doing well with cryptocurrency. And all you people who got in late, I'm talking about like, the last 2 years, things can't be looking too good for you. But like we say, hold on to them, and it's all about the long play and see how it goes. But if you feel you have to cash out, you can take that loss and write it off. So that's your decision that you have to make, and you need to check with a tax person to know the right thing to do there. So, Dope, I want to talk about our particular uh, show today, and it's kind of interesting because a lot of people was asking me questions when they saw our promo on it. It was like, Bob, ETFs. I don't know anything about them. Well, today's show is going to be our exchange traded funds better than mutual funds, because what's happening, a lot of companies are starting to convert these mutual funds to ETFs. So we thought we'd talk to you about it.
Yeah, and since March 2021, Fidelity has converted like 50 million mutual funds worth about $60 billion in assets to ETFs. Okay, the popularity of ETFs is such that there's going to be a lot more conversions on the way. So we're going to talk about what you need about this investing trend and how it might impact you. It's not clear yet if that will ensure if the fact that you switch it to an ETF that will attract more investors, but this trend has accelerated and significantly more are expected in the future. And there's several reasons behind this trend. Investors generally love ETFs, and with showing money going in there, in the case of most mutual funds, they've converted to an ETF. The company has hoped to attract more investors. But again, we don't know if that's going to happen. And it's a lot easier. I think it's easier to understand ETFs than mutual funds. And so I think it's easier for people to invest in it, to look at it and say, okay, this is what I want to do. And so we'll see if it's going to attract more investors. We don't know, but we're going to go through and help you decide which one's best for you.
Right. And that's what you have to make that decision. We're not going to actually tell you which one is right or wrong because we don't know your personal financial situation. But we thought it's important because that's what this show is about, informing people about different investment options. We're not favoring either one. We just know that we know the people that have mutual funds, and there's people out there that have ETFs. And if you don't have ETFs, and your mutual fund is being converted to an ETF, you need to understand, what that actual vehicle does. Because remember, our whole premise is that you need to know. If you're into something, you need to know about it. You can't just, be, guessing or just, not looking at it or taking the word of a financial advisor. You need to have some information about it. So that's what we're here for.
And Bob, it's hard work building wealth. And I mean, it is. We
yeah,
can't.
we say that all the time, don't we?
Yeah, it's not by luck. It's not like buying a lottery ticket. It's hard work, discipline, a lot of times sacrifice of not wasting money. But if you just have discipline and you start saving, especially if you start early and you are disciplined, you can do it. But it's not easy. It's not easy to build wealth.
Yeah, but the dichotomy about that is the more you know, the better it becomes. And that helps you along the way. Like we said, yeah, it takes work, it takes research, and it takes time, and it takes effort. But one of the things that help you, if the more information you have, the better you will be off. Now, here's how the process typically works, because a lot of people are getting into ETFs, and ETFs is becoming a big trend. Now, after a fund company decides to convert a specific mutual fund to an ETF, exchange traded fund, there are several steps to complete. Typically, the fund company will notify the mutual fund's existing investors of their intention. In some cases, this may require a shareholder vote to approve the conversion. Now, thereafter, most of the operational aspects of the conversion are the responsibility of the mutual fund company. Now, it's worth noting that investors in a converting mutual fund without a brokerage account may need to open one to hold the ETF after conversion is complete. Now, once this approval is given and granted, all other steps are completed. The fund assets convert tax-free to an ETF. Now, for investors, one of the main benefits of the ETF is the potential tax efficiency. That's a big, big, big plus other than mutual funds. It's a big difference. And once you convert to an ETF, the fund can take advantage of the potential tax benefits afforded by the creation and the redemption mechanism for ETFs when you go to redeem the ETFs. Also, ETFs feature daily trading, enhanced transparency, and typically have lower fees relative to mutual funds. So, Doe, won't you tell them, just to give some people who don't know what ETFs are?
Yeah, you want to make sure you understand what it is. It's a type of pooled investment security, and it operates like a mutual fund. Now, typically, ETFs will track a particular index, a sector, a commodity, or some other asset. But unlike mutual funds, ETFs can be purchased or sold on a stock exchange the same way you can buy or sell a regular stock. Okay, it can be structured to track anything from the price of an individual commodity to a large and diverse collection of securities. They can be structured to track specific investment strategies. And the first ETF was an S&P 500 ETF, S&P 500 index, which tracks that S&P 500 exactly. And that's one still active today.
And that's a good explanation, though, about ETFs, because they're becoming more and more popular because it's a good investment tool. Now, what is a mutual fund? I know most of you all know that, but we just want to make sure we identify, and for those who don't totally understand mutual funds, it's just a pool or collection of assets that invest in stocks, bonds, and other securities. And when you buy a mutual fund, you get more diversified holding than you would with an individual security. And you can enjoy the convenience of automatic investing if you meet the minimum investment requirements. And that's one of the big differences between mutual funds and ETFs. Now, mutual funds have advantages, and just like every other security, disadvantages compared to direct investing in individual stocks. Why? Because we always talk about diversification and putting all your eggs in one basket. And that's the beauty of a mutual fund, because they have several different securities in one. So the advantages of mutual funds include the economies of scale, the diversification, like I said, the liquidity, you can get in and out of them very quick when you go to redeem them, and they are professionally managed. And we're going to talk about actively managed versus passively managed. However, these come with mutual fund fees and expenses.
Okay, so now the question, why would you invest in mutual funds or ETFs? Either one. Well, as Bob mentioned, the first reason is you get diversification. So you spread your risk across a wide mix of either asset classes. So you have different stocks or a different sector. So you are automatically diversified when you do that. Low cost. You can buy and sell large amounts of securities and without that big transaction cost you would have if you were buying and selling individual stocks. They're very convenient, straightforward. Many banks and brokerage firms, including Schwab, Fidelity,
Vanguard,
Trade, what's it called, E-Trade, they sell the general mutual funds. They all have their own line of proprietary mutual funds, as well as access to thousands of third-party funds. Now, the most important thing about mutual funds is that you have a professional manager. So you get the benefit of having somebody who's a professional or supposedly a professional. He's reviewing, researching, he's deciding what to buy, he's deciding what to sell, when to buy, when to sell, and he's making those decisions for you so you don't have to. Those are the reasons people invest in mutual funds and or ETFs.
Now, how do mutual funds and ETFs compare? Like I said before, both mutual funds and exchange traded funds pool money from many investors and invest that money in securities. Likewise, many investors own a mix of these funds. But before you decide what's right for you, there are things to consider. Now, how they're most similar is because they both generally provide broad, diverse exposure to an asset class, a region, or a specific market niche. But the key difference is mutual funds are executed only once a day by the end of the day. Right? They are valued at the end of the day, where the net asset value is calculated at the end of the day at a single price. Now, ETFs are exchange traded funds. That's why they call that, and can be bought and sold all during the day at different prices, depending on when you buy in that particular time of the day. That's the advantage that it has over mutual funds. Mutual funds has a single price, and that's that price you get at the end of the day. And you'll see it's called the NAV, the net asset value. But ETFs sort of trade like stocks, and that's a big benefit.
Yeah, now, how do mutual funds and ETFs compare? Both of these items pool money from many investors and invest that money in securities. Many investors own a mix of these funds. You can own several different mutual funds or several different ETFs. So before you decide which one's right for you, there's a whole lot of things to consider. Now let's talk about how they're similar. Both generally provide broad, diversified exposure to an asset class, region, or specific market niche. And a key difference, and I think we've mentioned this before, mutual funds, those trades are only executed once a day, at the end of the day, at a single price. Okay. ETFs are exchange traded and can be bought and sold anytime during the day at different prices. So keep that in mind. When you sell a mutual fund and you decide to sell it, if you sell it at 9:30 in the morning or 4 o'clock in the afternoon, the price it sells at will be at the closing price at the end of the day. And so keep that in mind.
Yeah, don't. I definitely stepped all over your part. But you just want to make sure that you know that those differences, index ETFs are sort of like index funds, and they usually are designed to track with or keep up with a specific index, where mutual funds, they're trying to outperform the market. And that's a big difference, like
And that's a key point, Bob, because
yes.
and we've had this discussion too, that everybody, any advisor worth his weight in gold is going to make the comment that he's going to beat the market. And so when you think, and we've told you before that I think the number was like 90% of investment advisors do not beat the market, but that's the aim of most mutual funds. And so when you consider investing, whether it's a mutual fund or ETF, if you pick the S&P 500, you're going to do at least as good as 90% of the investment advisors that are actually working. So keep that in mind.
So let's discuss a little bit more, Dope, some of the differences. I like to share a chart with everybody so we can actually visually see. We spoke about it, but let's get into some of the differences of these ETFs and mutual funds. How they're managed, just like I said, ETFs are both actively or could be passively managed, but most of them are managed passively by fund managers, meaning they're just tracking it to a particular index, to like Standard and Poor's. And most ETFs are, passively, and they performance on a particular index. Now, the mutual funds, like we say, they're both active and index variety, but most are actively managed. And actively managed funds are managed by actually fund managers. That's why they cost more. Now, how are they traded? We talked about ETFs are traded like stocks. They bought and sold on the stock exchange. The prices change throughout the day, and you can purchase them anytime throughout the day. This means that the price which you buy ETF will likely differ from the price paid by other investors. Now, mutual fund orders, like we said, they're executed once per day with all investors on the same day receiving the same price. That's a definitely big difference. Now, what's the minimum investment? Now, because ETFs trade like stocks, they do not require a minimum initial investment. Now, that is a great advantage, a great pro, and are purchased as whole shares. Now, you can buy ETF for the price of just one share, usually referred to as the ETF market price. Now, mutual funds, they usually have a minimum initial investment somewhere, sometimes around $2,000 or $2,500, depending on if you do automatic out of your account automatic investing, then you can invest as low as probably $50 or $25. But if you don't use automatic investing, they usually have a minimum requirement, and it's a flat dollar amount, and it's not based on the fund's price share. Unlike ETFs, mutual funds can be purchased in fractional shares or fixed dollar amounts. Just want to say the other thing is the cost. ETFs have an implicit and explicit cost, while your broker will disclose the cost of trading. Commissions and ETFs providers will disclose the operating expense ratio. That's the amount of money they charge you for managing your fund. And you should always look at the expense ratio, and it should be less than 1%. Now, don't overlook the bid-ask price spread. Bid-ask price spread. Now, mutual funds do not have that. Mutual funds, like I said, they just have one price. But ETFs have, they have a sell price, which is a bid, and they have a buy price, which is the ask. And there's a spread in between that. So depending on which side you're doing, it's going to be how you're going to be charged commission-wise, price-wise, where mutual funds, they're just trading. So most of them trade without commissions, like especially no loads. So that's a big difference and advantage of mutual funds. And the last thing we want to talk about is the tax efficiencies of ETFs. They generate fewer capital gains for investors since they have lower turnover, and they can use the in-kind creation or what they call a redemption process to manage the cost of the holdings. Now, mutual funds, may trigger capital gains for shareholders, even for those who may have like an unrealized loss, meaning if you haven't redeemed them, that's an unrealized loss. You don't trigger a tax implication until you sell them, and that's called realized gains. But if you don't, that's an unrealized, meaning you haven't sold it. But with a mutual fund, you can still be charged if they distribute the capital gains to you as a stockholder. That can create a tax implication for you.
Yeah, and again, let's run through the differences between those two, Bob.
Okay, good.
The next chart. We've covered most of this, but just so you can kind of see it side by side. So, like we just said, the expense ratio is going to be higher on mutual funds, basically because you're paying for an asset manager and other administrative fees. You look at performance, it's generally going to track an index. A mutual fund's trying to beat the market, okay? And it's trying to outperform whatever that benchmark index is. You got about 2,000 ETFs you can choose from. You have about 7,000 mutual funds. Even though some of them might be closed to new investors, you still have 7,000. We've already told you that the trading of ETFs is, you can trade it anytime during the day. Mutual funds are only traded at the end of the day. ETFs are sold at market price. Mutual funds are sold at net asset value. And that can get a little tricky too, because you can have a bid and ask price on ETFs. And so you may have a spread there. Usually that number isn't very large, but it could be. ETFs are much more tax efficient. You don't get the surprise at the end of the year of the capital gains distribution. Mutual funds are less efficient. And as far as holdings transparency, holdings are generally reported daily. Whereas if you got a mutual fund, they only show what they have either monthly or quarterly. So those are those two investment items at a glance.
Yeah, that's a good breakdown, Dope. So one things I want to discuss with you, because we went through this, so the question will probably become, is ETF or mutual fund, which is right for you? And that all depends on your goals and the type of investor you are. Now consider an ETF if you trade actively, intraday trades, meaning throughout the day. You can have stop orders, limit orders, options, short selling. All are possible with ETFs, but not with mutual funds. Say your tax sensitivity. ETFs and index mutual funds tend to be generally more tax efficiency than actively managed funds. In general, ETFs tend to be more efficient tax-wise. So that would be the reason why an ETF would be right for you.
Yeah. And let's say you want to buy, when should you consider an index mutual fund or a mutual fund? So if you invest frequently, if you make regular deposits, like you do it out of your paycheck, or you do it every month or every quarter, you might want to you'll be better off with a mutual fund. You get that dollar cost averaging. You can get a no-load index mutual fund, can be cost effective and allows you to fully invest the same dollar amount each time. And you can buy them in fractional shares. And so when you buy or sell ETF shares, the price may be less than the net asset value. And that's what I was talking about a minute ago. That discrepancy is the spread between the bid and the ask. Usually it's not enough to worry about, but in some cases it could be a large amount. Mutual funds always trade at net asset value. There's no bid and ask spread. It's going to sell at the end of the day at the net asset value of that's the value of all the holdings divided by the number of shares. And so if you're looking for a fund that could beat the market, people invest in actively managed mutual funds and hope they'll surpass the benchmark. But again, very few mutual funds beat their respective benchmark. So just be aware of that. Now, but that's not the only criteria. in picking a mutual fund. It's not always about return because there's always a risk element. And so if you're being conservative, by definition, you're not expecting to beat the market. Okay. So just in general terms, theoretically, if your risk tolerance is 7 out of 10, you really should only expect to do about 70% of what the market does. So you can't look at it and say, I'm slightly conservative and I want to beat the market. Those two things are mutually exclusive. You'd have to be 100% invested in the market in order to consider yourself trying to beat the market. I hope you understand that. And so if you invest in an actively managed fund, you're expecting to beat the market. And let's make sure you understand that. And again, it's not always in beating the market, because sometimes you want to recognize your risk and you're willing to forego some return in order to alleviate some risk. Bob, I'm not sure I did a good job explaining that. Why don't you give it a shot?
Well, first of all, the question is, why are we telling you about this, ETFs and mutual funds? And the reason why is because a lot of people ask me after we do the show, when me and Doe talk about building wealth, we don't speak about specific tools or security investments to get involved in. And this is one that is, pretty easy, to do, ETFs, and especially mutual funds, because I know a lot of you all, especially that work with me at the FDIC, your 401k plans are really, that's what they're like. They're in, a lot of them are in mutual fund type of funds, like growth funds, the bond fund, and there's several different bonds. So that's why we're talking about this. But Doe, I think you did explain it as best you can, because it can be kind of complicated, but that's why we're trying to make it simple, because if you want to, leave your money in a savings account, even though savings accounts are doing pretty good right now, but they're not going to stay like that. You need to look at diversifying your portfolio, and ETFs, even though they're the trend right now and a bunch of people are getting into them, that is a vehicle if you're trying to build wealth, that's one of our primary goals on this show. This is another alternative that you can get into. And like we said, they're a little bit easier because you can purchase them any time of the day. With mutual funds, you can only purchase them at the end of the day. Well, you can only purchase them for the price at the end of the day, one single price. But ETFs is a great vehicle. And Dote said before, there's so many companies that have them, from Fidelity to Vanguard to T. Rowe Price. Everybody have them. But the thing is, we just wanted to get you a better understanding on what they are. So, Dote, question to you.
Hey, Bob, let me give it one more try before we go forward, just to satisfy myself. Let's just say you have $100,000 to invest, and if I had 100,000 and Bob had 100,000, and
do a little less money so people won't feel you're not talking about them. Say you had 10,000.
Well, 100,000 is okay. 100,000 is easier for me to work with. Anyway.
Okay, do 100,000. My bad. Do 100,000.
So Bob and I have 100,000. My risk tolerance is more 70% with a 30% conservative piece. Bob's risk tolerance is probably 30% with a 70% conservative piece. So if we were to take that 100,000 and invest it into an index fund or a mutual fund, mine would be 70% invested in something equivalent to an S&P 500 fund, and I'd have 30% in government securities or various safe bonds, right, or money market. Okay, so if the S&P 500 goes up 10%, I'm not going to make 10%. I'm only going to make that 10% on 70% of my holdings. And that 30% is going to make whatever the money market and government securities would make. Well, Bob's situation, he would only make that 10% that the S&P makes on only 30%, but his 70% would make the government securities. So when you talk about beating the market, or if you wanted to look at your advisor and you're trying to gauge how he did, make sure you take into account the fact that he's factoring in risk. So when we say 90% of the advisors don't beat that specific index, most of or part of the reason is because they're factoring in some sort of risk element. And so you got to compare apples to apples.
And two, though, let's throw this out there too now. Most advisors, and I know we talk about getting advisors to help yourself. That's different. A financial advisor is different than an investment advisor. I want to make that difference, though. Although they use some of the same things, and a financial advisor factors in way more factors than an investment advisor. Investment advisor is totally that. Investing in stocks and things like that is not getting into financial planning. It's not getting it, although it'll ask you your goals. But understand there is a difference. And they will be a little bit more aggressive. Well, it depends on the financial advisor. But I wanted to make that there is a difference between a financial advisor who looks at everything, budgets. I'm talking about, financial planning people. They're looking at your budget. They're looking at emergency funds. But an investment advisor is just doing that. So you need to make sure they know what your risk tolerance is, because investment advisor could have a way more risk than you are willing to take. Or some. Go ahead.
And the other pieces of it is tax and legal. A lot of the, for example, Fidelity will tell you they don't deal in the tax part, they don't deal in the legal part.
Right.
And so they don't give tax or legal advice. And so you got to make sure that's, now the legal part is obviously less important unless you're dealing with corporations or subsidiaries or you own businesses and things like that. But the tax part is a real important part of that portfolio. So that's another piece where you need to get professional advice if you don't understand all the underlying importance of what's going on tax-wise. So,
and so the thing is, okay, once again, just for clarification, mutual funds, ETFs. I want to make it clear. There are some mutual funds that are investing in index funds, right? But remember, mutual funds have a minimum investment tied to them. Mutual funds have a tax implication into them. Okay, so don't get confused. Wait a minute, I thought they sort of sound alike. Yeah, they're a pool of investments, and that is true. But then it depends on the management, because if it's actively managed, they're looking more aggressively to try to outperform whatever that index is or what the market is. If it's an ETF, they just tracking along whatever the market is doing. They're not trying to outperform it. They're just doing with the market. So that's what Doug was trying to clarify too for you. This difference between these two investment vehicles, but it's important that you know, because they work. Both of them work. Both of them work, and like we said, which one is right for you depends on your investment goals. Your investment style, your risk, and that's with everything. Even if we talk about individual stocks, that's the same thing. Even if we talking about CDs, something with low risk as CDs and savings accounts, you need to understand, what is your goal and horizon and how much risk is involved, because that depends on how fast your nest egg grow. And we always say this, and I'll end with this, like we always say, you will not become wealthy leaving money in a savings account. I think, can I go off that bold and say that, though?
Exactly. You may do okay over the short term, like now with money markets paying like 5% and the Dow kind of struggling right now. But over the long haul, nothing has done better than the stock market.
And this is another vehicle to be in the stock market. Okay, though, let's go to the summary and takeaways with it. Because as usually, we gave a lot of information. We had 20 pounds of information in a 5-pound bag. So here we go. Bam. Here we go. So I'll take the first one, though. We cannot say this enough. Understand what you are investing in. That's all we're trying to clarify tonight is, are ETFs better than mutual funds? And I hope you see at the end of the night is for you to determine which is right for you. And we always say, man, because most people, they shun because some of this information, I know even tonight, it may, be complicated or may sort of go over your head. But we try to break it down as much as we can because we want you to know, because you only know what you know. So we're trying to share information.
Yeah, avoid the hot new thing. And by that, we mean, there's a bunch of ETFs and or mutual funds to choose from. And it's easy to look at one that has done well in the short term. But do the work, do the research, look at the history of it, even though that doesn't guarantee what it's going to do in the future. But if it has a good track record, that's probably a good indication that it's well managed or it's an index that's continuing to grow. Do your research, pick out what's best for you, and move forward.
And there's an ETF for everything. It's over 2,000. They got ETFs for technology, just technology stocks. They got ETFs just with oil and gas. They got ETFs with just AI, artificial intelligence. They got ETFs with bonds and not with bonds. Excuse me, that's mutual funds. But they got ETFs that are in everything. I mean, international stocks. So don't get caught up into the maze of all these ETFs, because more and more of them are coming out. But make sure you just choose the one that's right for you.
Yeah, and they definitely can have a place in your portfolio. And it's just for you to decide which one. You got to look at the situation that what you're trying to accomplish, and determine whether you want a mutual fund or whether you want an ETF. But it definitely should have a place in your portfolio.
Yes, and we hope, we didn't make it too complicated for y'all, but we truly believe that um, building wealth is about gathering as much information you can so you can make the proper, or not proper, but just make the good financial decision because you have the information at hand. And that's what this show is all about. So we hope you learned a lot about ETFs tonight. And I know some of y'all knew about mutual funds, but I'm sure you learned some more about mutual funds too, because it's so many, it is so many investment vehicles out there these days, just like cryptocurrency, just like corporate bonds and treasuries. But it's all about picking the one that's right for you. So we hope that helped everybody. And man, thank everybody. And just want to do the roll call because thank you, my sister Gloria, saying once again, great information. My sister Linda, how you doing? Oh, and then my other sister Nolia. So I have to give my shout out to the Kinza girls. They some stylish mugs too, though. Then I'd like to say hello to Garnett and now Dodie with your wonderful self now. Thank you very much. And she said hello and congratulations on 118 shows. Yeah, that's right, too. And Rodney L. Madison Sr., the noteexperience.com, which is another alternative to investing. Go out there on the noteexperience.com, you all, and see some other vehicles to invest in out there. Hey, what's up, James Alexander? You just jumping on here, man. Good to see you. Garnett, how you doing? And my brother, Carl Chapman. How you doing, Carl? Hey, Carl, I know you got some questions about this. Put something in the comment box before we go off, because I know you be Mr. Quiet Man laying back there. What's up, Joanne? Always a pleasure seeing you, and want to thank all the people that I can't see out there. Thank you for joining us. So I hope you realize whether ETFs or mutual fund is the right investment for you.
Hey, Bob, there's we always talk about Dave Ramsey, and he has three things that'll make you broke. And I just wanted to share one of them with you today. And
Okay.
these are as true as can be. And his first one is pride. How pride can make you broke. So you buy a car to impress someone at a stoplight that I will never meet. Think about that. Would I buy this if no one ever saw it? That's your test on the pride button. Ask yourself if you would buy it if nobody ever saw it. I just wanted to close with that one.
No, and oh, you know what? I had a question though that I was going to ask you before we go.
What's that?
Because you're an individual single stock man. Do you have any mutual funds?
I have one. I have a little bit of money in an equity income fund. And it was just kind of something that I had that I didn't want to put in the money market. And I didn't have a stock that I wanted to buy. So it's one that pays a pretty good dividend because it's, again, equity income means it invests in stock and income instruments. And so, yes, I have a very small amount of one mutual fund.
But what's so interesting though, but you are like a mutual fund manager because you got several different stocks in different sectors. So you're acting like the money manager in the mutual fund. That's why it was a trick
question. I don't know if it's luck or skill, but buying NVIDIA, buying Microsoft, I've done really, really well. The only loser I have is Pfizer, and Pfizer has not done good for me. But everything else I own has made me a pretty good penny, from Apple to Amazon to Costco to NVIDIA. NVIDIA, like a triple my money. So I've done okay.
And that's why I just want to share that with people because you have the expertise, you acting like a money manager, fund manager, by having several different stocks in different sectors. So
yeah, but I've often thought about doing it as a business. I don't think I could be risky with somebody else's money, and I would hate to tell somebody that they lost some money. I don't have the heart to do that, and I don't anticipate losing money, but we all know it does happen. That's probably the only thing that would keep me from being a financial advisor. I'd hate to bring bad news.
Well, though, believe it or not, I was a financial advisor. I was an investment advisor, and a stockbroker. And that's one of the reasons I got out, man, because, it just, when people lost money, man, it kind of hurt me, but other guys, they just was cold-blooded. They got their commissions and went on about their life. But I would sit back because, some of these were friends, and I'm like, man, I like you say, man, it was pretty tough, man, business. Because like we say, there's no guarantee. Past performance is no guarantee for future returns. That's what they say. But anyway, you froze up on me there. Okay. So anyway, you all, thank you all for tuning in again. Next week would be the 21st of September. We're looking forward to you all tuning in. And thank you all. And we see you next week.